touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Mihir. You're watching IndianOpen. Let's go straight to the headlines this Friday morning. UK Prime Minister Theresa May vows to go ahead with her Brexit plan despite facing stiff opposition from within her own cabinet. Back home, India's trade deficit widens in October despite exports posting an 18% jump last month. The Indian government is said to have nudged Tata Sons to buy stake in Jet Airways. That is a Bloomberg exclusive. And it's the second high-profile exit from Yes Bank in as many days, with CEO search panel member OP Bhatt choosing to step down. And that will continue to remain a stock in focus. I think 2 or 3 stocks will remain in focus and we'll talk about that. But first, let's take a look at the trade setup for the day and what would it mean for you when the markets start off trading at about 9 a.m. The world markets, a mixed bag of sorts. S&P snapped its 6-day losing streak, so up about 1% for the S&P 500. Dow was up about 1% too. Nasdaq 1.7%. Tech did bounce back, but well, this was in the offing because you can only go down as much at a single point of time without too many reasons before bouncing back a little bit. So a bit of a bounce, and the reason I say that it is a bit of a bounce, which people may not believe will last or no, because Asia is trading a mixed bag. Nikkei is down about 0.5%, Shanghai and Hang Seng down about 0.25% and 0.75%. SGX Nifty for now showing an uptick about 41 odd points. And just very briefly, 2 or 3 news flows around the Asian markets as well. North Korea has done some test, whether it's a nuclear test or otherwise, or rather presided over some testing of a weapon. Now that has happened. There are some South Singapore premier has said that at some point of time the ASEAN nations will have to choose between China and US if the trade tensions don't diffuse. So a lot of news flow, nothing that has an immediate impact on trade. And which is why I reckon that the world markets and the Asian markets at the start of the trading day are a mixed bag. What did our markets do? And frankly, in trade yesterday as well, is a bit of buoyancy selectively within the large caps and specific mid caps as well. I think mid caps underperformed the large caps in trade yesterday. But if you just look at how the trade setup looked like, the max OI for the November series still at 11,000 call. On the put side, about 10,200 put as well. So that's the broad range that we are working with halfway into the November series. And while flows may have optically looked positive yesterday, about 2,000 crores. Remember, this has the bulk deal data of Kotak Bank as well, which is to the tune of 1,500 odd crores. Having said that, I reiterate the point that what's happened over the last few days is that the large incessant selling by the FIs that happened throughout the month of October has completely gone away in the month of November, and which is not a bad sign at all. There will be a clutch of names which will carry on from trade yesterday that we'll watch out for. But in terms of newsmakers in the session today, something that could move based on news is tough to find. What would happen? Yes Bank is a headline, and Yes Bank will or improbably could react. But I thought I'll talk about 3 mid-sized names which could be in focus to my mind in the session today. Jet Airways, for more reasons than one. The Indian government, in the Bloomberg news, that the Indian government is said to have asked the Tata Group to rescue the company. This is Bloomberg reports, and this really, I think it was a whiff of this that got the stock to trade what it did in the last half an hour of trade yesterday. For all those who missed and are just looking at the number of 24%, keep in mind that the large portion of that gain happened in the last 30 minutes of trade. So big volume jump, big price jump, and because the volumes went up, you won't have the delivery percentages higher. This is the intraday chart, and thank you for bringing it up. But just that, the last half an hour to 40 minutes is when we saw the bulk of gains in Jet Airways. And yesterday, the quantum of shares marked for delivery also jumped. Remember, the percentages will look weak because the volumes jumped up so much. But look at the quantum of shares marked for delivery. Yesterday it was about 29.5 lakh shares. Otherwise, for all the preceding days, it's sub 10 lakh shares. So a lot of delivery-based buying that happened. As a percentage, it would pale, but in absolute terms, fair bit of delivery-based buying that happened in Jet Airways as well. Technical experts yesterday did mention that they believed that the targets now open up northwards of the current prices, at least 50-60 points higher than the current prices as well. So it'll be interesting to see if there is some activity in Jet Airways in the session today, some positive activity in Jet Airways in today's session as well, after the move that it had yesterday, arguably after the move that it has had over the last 3 or 4 sessions. SRF, and you know, I wouldn't normally bring this up, but it's interesting. The specialty chemical major extending the capex estimates from 180 crores to 257 crores. It's happening selectively within a lot of industries that capex is now getting announced, which would happen if the current capacity utilizations at the plants are nudging those 80-85% levels, which is essentially a good sign for volumes. It's happened in cement selectively, it's happened in select other pockets, and now SRF is extending the capex requirement as well. Should be interesting. Let's wait and watch what happens here. NRB Bearings, small stock, but HDFC Mutual Fund has acquired about 14.4 lakh shares at 184 or 185 each. This will be interesting to watch if this one has a bit of a reaction. And keep on mind, I will keep on watching out for what's happening to the tire companies and some of the others which benefit as a result of crude prices coming off. We have extended gains coming in for all of those crude beneficiaries. So watch out for all of those names. However, let's tell you what lined up on First Word today is the collection of the top editorial stories that we believe we should bring to you first up. The government's nudge with notwithstanding, does it make sense for Tata Sons to invest in Jet Airways? Sajid Mangat joins in with the pros and cons. Then the government is also counting on state-run companies to get in 20,000 crores from share buybacks this year. So which PSUs have the cash to fund this? Somit takes us through the math. Second quarter earnings season has drawn to an end. Darshan takes us through the performance of all the companies. And as I said, tire makers may have a reason to smile now. Yatin Johnson and tells us why. Let's start off with the big news. N. Chandrasekharan will make a pitch to the Tata Sons board today. The group chairman will propose that the Tata Group make an investment in Jet Airways, a plan that has the government's backing, according to Bloomberg News. So does it make sense for the Tata Group to look at the debt-ridden airline, especially when it already has 2 airlines of its own? Sajid Mangat joins in with possible, probable answers. Sajid, good morning.
Good morning.
Now, with the government's backing, you'd believe that almost anything can be done. But the fact remains that they have 2 airlines which are not in the best of shape per se, and they are probably going to be making a pitch for a third one. What sense does it make for Tata Sons?
You know, if you look from the government's point of view, there is currently only one full service airline in the country, private sector. Air India being the other one, which is already in debt, and it's going through various revival plans and other stuff. In the private sector, there is only one. If Jet goes down, then India will not have its own private sector full service airlines for sure. So that could be one of the nudge which is coming from government, saying that we don't want the aviation sector to go down that way. So if it's possible, you should be able to take look at it from that point of view. From a Tata's point of view, they already have one JV for low service, low-cost airline, one for full service. Air Asia hasn't been doing much there, and there has been some murmurs about how Air Asia is not satisfied with the kind of operations, and even Tata's are not. Air Asia has not been able to scale it up. Singapore Airline JV, which is Vistara Airlines, where Tata's have 51% and Singapore Airlines has 49%. It's actually been run by a CEO appointed by Singapore Airlines, the former CEO of Silk Air. So the control is with Singapore Airlines in terms of that, because Tata's can only appoint a CFO. What I understand from insiders is that they don't want a third airline to come into the kitty. It will be 2 airlines. So one of the airlines, which probably be Vistara, may be merged with Jet, and that's the way to go forward. But the questions which they are trying to grapple is how effective they will be in turning around the airlines, because from an asset point of view, Jet is a much better asset than Air India for them from a debt, because their debt is around 11,000.
The smaller of the 2 evils, if you will.
Exactly. But there is a belief that it is easier to turn around Jet than Air India. And given the fact that if you remove the promoter from Jet Airways and bring in a professional management, it is possible that Jet can become profitable. That is the belief there, and the reason being that because among the private airlines, Jet has the best slots in various international airports. They have multiple hubs, which is there. Amsterdam is one of them. For Singapore Airlines point of view, today they are not able to access the Middle East. the only access they have to is to India. This extends this access to the Middle East and the European countries with a hub in India for them. So it becomes a bigger play for them. And Singapore Airlines is also backed indirectly by the government of Singapore through funds and other stuff. So from that point of view, it makes sense for Singapore Airlines, and they have the expertise in running a full service carrier. Within the Tata Group, I've been told that Chandra has the expertise in looking at airlines, because for the last 25 years they've been servicing a lot of airlines through TCS. So the entire operating systems, how the airlines work.
Are you saying that the Tata Sons chairman might actually take active and full-time interest in this?
This is what I'm hearing, that the TCS chairman, Tata Sons chairman Chandra is more gung-ho on this deal than anyone else, because he's seeing the potential of this turnaround. They've been working with British Airways for 25 years. They have been working for Lufthansa, KLM. You name any airline in the world, they have worked with them. So they know the operating back end that goes into it. So they can get in the best of the technologies to ensure that there's a smooth running of efficiencies. Today, if you see Jet Airways, a lot of bleeding happens through the international routes because the cost per employee or cost of running international is much higher than even Air India.
Yeah, say for the last quarter when I think the domestics did very badly and the international routes did okay. But yeah, I take on board your point.
But if you compare Air India to a Jet, you see that the international operations of Jet is much more expensive and costlier than Air India's. So there is a lot of turnaround that can be done in there, and that's a belief they're doing. So what's going to happen today is we are not in an advanced stage of any deal or something, because both Vistara actually the JV has to take a call. The Tata Sons board will be apprised of this opportunity, and they will be told what can be done. They will get an an agreement from or approval from the board, and then is when they move forward with Jet, as and when all the approvals come in. So it's going to be, the deal is not going to happen over the weekend. Let me put it this way: it will take much more time because a lot of due diligence has to be done, and I'm told that as they do due diligence, there are lots of complications which are coming in. Which respect to where the money is going, what kind of operations are there, because Jet has a lot of international operations, and so they have to be very sure that they're not putting money in something where it doesn't become a Tata Tele for them going forward.
Got it.
So that's the perspective from the Tata Group. They believe that they can run the airlines. They don't want the third one. They will take only two, and so the expertise of Singapore Airlines and the technical and operational technological expertise of Tata Group through TCS can bring in that efficiency into Jet.
Well, let's wait and watch. And frankly, I think Sajid would probably agree with me that it's very difficult to fathom what would happen. What does this mean for a Jet Airways shareholder per se? But the fact that
the deal has to happen quicker, because in the next 2 years you have nearly 6,000 crores of payments coming in, with nearly 3,000 odd coming in FY19.
I'm guessing if there's a government backing, then all of these things would be taken on board.
Because the point is that
yesterday the news came about from Bloomberg that banks might be asked to take a bit of a haircut as well. So all of those factors
you cannot take a haircut till you go to IBC. Let me put it this way. Means on what basis will you take a haircut? You have to go to the IBC, put a resolution in place, then only you can take a haircut based on what the resolutions come in. So there is 3,000 odd crores of payments which have been made in FY19 itself. So and if you look at the interest coverage ratio, is 0.2 or something for Jet at the end of FY18, and it's fallen from 1.2 or something.
So the deal has to happen quicker, but it won't happen today. There would be an announcement maybe of an approval of the board, but that is the extent of which it will happen. It will happen in a piecemeal basis. Sajid Bangat fervently hopes that if it has to happen, it has to happen quicker. Okay. Sajid, thanks so much for getting us those updates. And, that's from people who might be privy to the matter as well. Sajid Bangat gathering this information and bringing it up for us. Jet Airways firmly remains a stock in focus today. Okay, let's move on. 8:15. Let's get in the next piece on First Word, and that's the government eyeing 20,000 crores from buybacks announced by state-run entities in the current fiscal, according to a Bloomberg report. And one such company is Oil India, is going to hold a board meeting on Monday to discuss just that. But it'll take more than just one buyback to meet the government's stiff target, especially since it's got only a third of the amount thus far. So, Somit, the question is, which are the companies that can come to the government's rescue?
So I'll just show the companies that have actually done the buyback so far, and then we'll go to that. So if you see, so far 6 companies have come out with buybacks, and the total amount is close to 4,400 crore rupees, which includes BHEL, NLC India, NHPC, Nalco, KICL, and Cochin Shipyard. Now the buyback amount ranges from 200 crore rupees to 1,628 crore rupees. Now, other than these 6 companies, Oil India will be considering a buyback on November 19th, while ONGC will consider a buyback post December. Now, at least that is what the management said in the conference call. So these 2 companies might come out with a buyback. That's what they have said. Now, if you see, the government has targets to get around 20,000 crore rupees via buybacks in financial year 2019, and so far they have managed to get only 20% of this target. So let's see the companies that might that actually have the ability to contribute to this target. Now, we are not saying that these companies will do a buyback, but they have the ability to do the buyback. Now, if you see Coal India, now they have a net cash of close to 38,154 crore rupees, and the 25% of the net worth, which is one of the buyback rules. Now, according to the buyback regulation, a company can buy back shares worth 25% of its net worth with shareholders' approval, and it can do less than up to 10% of the buyback of net worth without shareholders' approval. So if you see companies like Coal India, Engineers India, MOIL, NBCC, Bharat Dynamics, and ITDC, now these companies have the ability to buy back 25% of their net worth because they have a net cash of more than that amount. Now, if you see, Coal India has a net cash of around 38,000 crore rupees, while the 25% of buyback is only close to 7,000 crore rupees, while ITDC has a net cash position of close to 292 crore rupees, while 25% of its net worth is close to 88 crore rupees. So these companies can conduct a buyback of close to 25% of their net worth. Now let's see the other list of companies. Now, companies like NMDC, Container Corp, SJVN, Balmalori, Andrew and Mishra Dhatu Nigam. Now these companies can buy back shares worth at least 10% of their net worth. Now, NMDC has a cash balance of close to 5,400 crore rupees, while the 10% of its net worth is only 2,600 crore rupees, while Mishra Dhatu Nigam, now that has a net cash of close to 84 crore rupees, while 10% of its net worth is only 78 crore rupees. Now, other than these 2 set of companies, the other companies that are still in a net cash position are BEL, Hindustan Aeronautics, Oil India, and GAIL India. Now, these companies have a net cash position of close to 600 to 2,200 crore rupees. So these companies might also consider a buyback in the financial year 2019 to meet the government targets. Now, let's see those companies that have actually performed buyback in the last 2 years. Now, if you see, in the last 2 years, nearly 10 companies have come out with buyback, and the buyback amount was close to 25,000 crore rupees, of which, if you see, MOIL and BL, they have conducted buybacks in the last 2 financial years. Now, Bharat Electronics has conducted a buyback of around 2,100 crore rupees in financial year 2017, while in financial year 2018, it did a buyback of close to 372 crore rupees. And MOIL has conducted a buyback of 863 crore rupees in FY17, while in FY18, it has done a buyback of 210 crore rupees. While other companies like Oil India, Engineers India, SJVN, Coal India, NMDC, Nalco have also conducted buybacks in the last 2 financial years.
Well, that's interesting. Thanks a lot for that, Somit. And remember, as Somit said, that we are not saying that these are the companies that will come to the rescue. These are the companies that have the strength, the balance sheet, the P&L strength to come to the rescue. Okay, the buybacks is a big hot topic. The other hot topic is the earnings season, which has finally come to an end. And the second quarter earnings season, there were definitely some disappointments, even from traditionally stronger pockets. Darshan Mehta is now standing by with a final scorecard of what did well, what didn't, and what just about managed to meet estimates. Darshan, good morning.
Yeah, good morning, Neeraj. Not the best of earnings seasons. I think we did the search thing when it was 44 companies. Now the entire 50 companies have come out with numbers. So what we're seeing this time around, close to half of them have come in line with numbers which were in line with estimates. 11 were strong and 16 were weak. What is surprising is that the number of companies which report strong numbers have gradually gone down, if you see, for the past 3 quarters, and the company that came out with weak set of numbers is pretty much the highest that you saw in the last 5 quarters. So it's not the best of earnings season so far. As far as the other trends are concerned, concerned, which were the companies that managed to come out with strong numbers, weak numbers. So you can clearly see that, it's the yellow and red that dominate, and the red one is pretty much just one line. And surprisingly, some of the private sector corporates facing banks did well. Dr. Reddy's, optically the numbers were good, but overall, if you look at the commentary, not the best of commentaries. Some of the metal counters, some of the port counters doing well. IT Tech, as well as some of the financials are pretty much in terms of numbers which were in line. So that's the broad trend that you're seeing. Now this is interesting. First quarter, the actual EPS was 114.3, but this was on account of big loss by SBI. Otherwise, it was above the 120 level. When we started second quarter, and this is the first day of the month, that time the number was 129.1. When the actual earnings season started, and that was October 10th, that was when that was the first Nifty company to come out with numbers. They came out with numbers. The estimate was 124, and finally, where have we ended? We ended at almost 121.4. So we missed the earnings estimate that by a mile, as far as what was anticipated at the start of the second quarter, and even what was started when the earnings season started. So that's the actual scorecard for you in terms of EPS. What caused the EPS cuts? Sun Pharma reported a loss this time around. Grasim also came out with a weak set of numbers as far as the recurring EPS is recurring PAT is concerned. Tata Motors and the oil marketing company. So these were the major contributors why the EPS came down this time around for the Nifty. Now, what have been the EPS cuts during the second quarter? This is from the start of from October 10th till now. What were the cuts that have come in? Tata Motors, the EPS cuts have been 52%. Cipla, the EPS is down 12%. Vedanta, Ultratech, and Hero MotoCorp. So these are the companies in which there has been an EPS cut that's come in, and an EPS hike is seen in companies like Grasim, Tata Steel, Dr. Reddy's, GAIL, and JSW Steel. So that's the trend that we're seeing this time.
So let's try and divide these sectors, Darshan. Which ones managed to meet or surpass estimates, and which ones failed to do so?
Yeah, so L&T, strong set of numbers. Construction and infra only company here, post strong growth with traction that was seen as far as the order flow is concerned. So that was the first company that you would have to give a thumbs up this time around. Adani Ports was the other one. Stronger, higher cargo business boost the financials for Adani Ports this time around. So as a pack, that did well. Media did well. Z is the only company there. Post strong quarters. After 3 muted quarters, it's come out with a number which was strong this time around. Strong growth both on the domestic and the ad revenue front. So media, again, we give it a thumbs up. Inline, HUL, the consumer name, not the best of numbers. Profit growth of profit up 19%, which was in line with estimates. ITC, the cigarette volume was strong, but the other businesses didn't manage to disappoint. And even in HUL, even the volume growth was strong, the financials, similar case with Asian Paints, strong volume growth, but the financials actually not the most encouraging. Margin hit on Titan this time around. So the consumer play this time around has been lackluster. The other story is basically the agri story. It did well in Latin America this time around, but pricing post second straight quarter of inline pricing. So UPL this time around was in line with what we had anticipated. The other one is if you take the sector as a whole, banking and financial services, not the best quarters. Some of them did well. ICICI Axis Bank was strong. SBI was strong this time around, but the IL&FS exposure hurt. Some companies like Yes Bank, IndusInd Bank, Kerala Flood hurt Bajaj Finserv. Bajaj Finance was slightly moderately better than what was anticipated. Not the best of numbers on the financial side. IT, again, no fireworks this time around. Wipro and Tech Mahindra were weak, and it was maintenance of guidance as far as the other IT stocks was also concerned. The other one is telecom was also not strong. Bharti Infratel did well than Bharti Airtel, but overall as a sector, you would have to say it was rather average. Metals, again, not the best of numbers. Hindalco managed to do well. It was mixed set of numbers. JSW didn't do well. Vedanta didn't do well. Coal India was pretty much in line with estimates. So metals as a sector was quite lackluster this time around.
Well, and Darshan, the disappointments, the bigger disappointments?
Yeah, disappointment. First of all, auto was disappointing this time around. As a sector, some of them came out with inline set of numbers, some of them came out with muted numbers. But overall, the demand headwinds is there. There is competitive pricing, weak monsoon, delayed festive season. Overall, not the best quarter that auto had. Cement also, UltraTech is the only one. Multi-quarter low EBITDA per ton is something that we saw. Margin pressure strong. Pressure was seen because despite strong volume growth, and this was across the cement stocks. UltraTech is the only one in the Nifty, but across, if you see ACC, Ambuja, India Cements, all of them reported weak set of numbers. Again, oil and gas as the space was rather disappointing this time around. You saw how crude prices played havoc with the oil marketing companies, but this time also Reliance didn't contribute this time. GAIL was the only one that managed to do post strong numbers. So oil and gas was weak this time. The other sector that we want to talk about is pharma. Dr. Reddy's optically was strong because of some markets doing well, but their core markets, US didn't do well. Cipla was weak across, despite the taro beat. Sun Pharma came out with weak set of numbers. So as a pack, pharma was also rather disappointing this time around.
Okay. Well, thanks a lot for that, Darshan. So that's the interesting bit in terms of the earnings that came out. And as Darshan said, a lot of disappointments, cement and a few other sectors certainly standing out as disappointing spaces. Let's talk about the final piece on first word, and that's tire makers. They witnessed a sharp dip. They had rather witnessed a sharp dip in margins in the September quarter, but with both crude and rubber prices cooling off, can these companies reverse some of these losses in the second half of the financial year, or at least the third quarter? Yatin Mota is standing by with an analysis. Morning, Yatin. Good times for tire makers?
Could be, Neeraj, because two products, rubber and crude oil, have come down, and they constitute nearly 60% of total raw material cost. But let's talk about the margins as to how really did they shape up in the last 8 quarters or so. So we are talking about C8 Apollo tires and JK tires, for which the data and the analyst coverage is available. And if you look at the margins, they have clearly come off, from the last 4 quarter levels. In fact, if you look at for C8, we had double-digit margins that came down to single digits, in Q2 FY19, which is the quarter gone by. Similar is the case with Apollo tires. The margins usually were in the range of 12 to 13%, and the second quarter, margins came in at 11%. Similar is the case with JK tire, wherein the margins, 2 quarters back were nearly 14.5%, but this quarter they delivered a margin figure of nearly 10.5%. So clearly, because of raw material cost pressures as well as rising crude prices, the tire makers face the heat on the operating performance. And let's talk about the rubber prices. We are talking about NCDX rubber prices which have clearly come off. And if you look at the sharp fall in the rubber prices after the Kerala floods, there was a spike up. And now look at the correction, almost a 20% plus kind of a correction has come in as far as natural rubber prices are concerned, which is almost, 40 to 45% cost of making a tire. If you look at synthetic rubber, which is a derivative of crude, that forms nearly 10 to 15% of total costs. And there also we have seen a significant amount of correction in the crude prices, which have moved below the $70 per barrel kind of a mark on Brent. So clearly that has also cooled off significantly. What remains is carbon black and nylon tire cord fabric, which constitute nearly 25% of total cost. So if you look at the costs of the tire company, clearly each and every moving part has come down in terms of the pricing, which means that with a lag of 1 quarter, we could see some good margin expansion coming in. In fact, if you look at the tire pricing factors and the demand factors, recently most of the tire companies have increased the tire prices cumulatively by nearly 4% for the truck segment in FY19. We have the passenger tire prices which have been hiked by nearly 2% in September, and the replacement-led demand remains healthy. Of course, the demand from OEM is slowing, and most of the analysts are factoring in that. But the replacement demand market is quite healthy as for the analyst expectations. In fact, if you look at Deutsche Bank, they expect a 7 to 8% CAGR growth for tire demand till FY22, and similar is the case for Citi, wherein they expect a 8 to 7% kind of a growth for the PV tire, which is a passenger vehicle tire, and the commercial vehicle tire, respectively, till FY21. So the projections of growth remain healthy. Of course, costs are something, because of which the earnings got impacted in the short term. But if you look at the valuations also for companies like Apollo Tyre, JK Tyre and CEAT, they are trading nearly 15 times FY19 earnings. And if you were to take into account FY20 earnings, then we could see another 10% fall in the price to earning ratio, which means that 1 year forward 13 to 14 times is what most of the tires companies are trading, which probably make it quite comfortable on the valuation front at least. Let's see whether or not tire companies are able to hold ground to the price hikes that they've taken, number one, and number two, how really does the raw material cost correction which has come in sustain, because that would determine the margins with a 1 quarter lag according to the analyst community.
Great. Okay, Yatin, thanks for putting this into perspective. Keep in mind 1 quarter lag, or maybe the markets like to discount some of these earlier, sooner rather than later. Let's wait and watch. The tire companies' results were also reasonably okay in terms of estimates. Maybe there's more upside in these stocks. But that's all that we have on First Word for the day today. Lots more lined up on Indian Open. Gautam Duggad of Motilal Oswal Securities will join us with an assessment of how the second quarter earnings have been. And we'll ask Mark Martin of Martin Consulting whether buying Jet Airways makes sense for Tata Sons. But after this break, a full tilt towards the day's trade.
Good news, got a promotion and a damn good raise.
Congrats बेटा।
वाह, रेज अब तो इंश्योरेंस पॉलिसी ले ले।
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा।
That's good, but आज की जनरेशन wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना, same choice. LIC.
LIC trending with times. 62 सालों से हर जनरेशन की पसंद।
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture $1 billion.
Good morning to all our viewers. You're watching Indian Open right here on Bloomberg Quint. Let me go across to Asia and highlight how we're trading and how the setup looks like right now. So it's not too sharp, but yes, it's still in the red for Nikkei 225, which is down 0.5%. Shanghai just about stabilizing with 0.2% cut, and Hang Seng losing closer to 1%. For the SGX Nifty, though, the indication is that you will see a slightly more stronger start this time around. Remember, we're just about holding on to the green territory for the week. So this probably would be the third straight week that we see positive gains for the index, if at all today's happens to be a good day for the markets. But we'll wait and watch how that shapes up. Early indications still point towards a stronger start. Yesterday's session, let's talk about that and what happened in the futures and options space. To highlight all of that and more, we've got Darshan joining in right now. Darshan, good morning.
Good morning, Devina. And the SX Nifty indicates that we will have a positive start currently. Yesterday, we saw short covering that came in on the Nifty. The open interest was down 0.3%, and the index managed to move up by almost 0.3%. On the Bank Nifty, yes, no doubt there was fresh buying. Open interest built up of 11%. The index was up 0.9% because the HDFC Bank fired, the HDFC Twins fired, ICICI fired, Axis fired, Kotak fired. So most of the counters did manage to fire in trade yesterday among the banking stocks. Now, where are positions being taken? We are at the 10,600 mark in trade. We are seeing from 10,600 to higher level call writers are active, and put writers are active from 10,600 to lower level. So the narrow range is 10,500 to 10,700, and the broad range is 11,000 right down to 10,200. So that's the broad range that we're looking at. Yesterday, since the market managed to move up in trade, we saw put writers become active from 10,600 to higher levels, and call writers from 10,700 to higher levels. So it looks range bound at this point of time, but it looks like with a slight positive bias. The PCR managed to move up both for the Nifty and the Bank Nifty. There are 3 stocks in the F&O ban. Adani Power and Jet Airways remain in the F&O ban, and Jet Airways again will be in focus because it's the Tata Sons board meet. And you have Adani Enterprises, which joins them in the F&O ban. Stocks which moved on high open interest build up yesterday. There was Apollo Hospitals, there was Ujjivan Financial and Just Dial. So Apollo and Ujjivan reacted positively to the numbers. Motherson reacted negatively to the numbers. NBCC reacted negatively to the numbers, and all of them on high open interest build up. As far as companies with either short covering or long unwinding, you can see all the companies came out with all of them actually reacted with short covering, with open interest drop of anywhere between 10% to 15%. So these are the counters that you need to watch out for. Jet, for one, I will definitely watch out in trade today. Remember, it's in the F&O ban, so fresh positions can't be taken here.
Got that. Darshan, thanks very much for that. So Jet Airways is going to be, a lot of eyeballs on that counter and how it trades today. Remember, like we've been highlighting, most of yesterday's gains came in the last half an hour to 40 minutes of trade as this news started to gain more traction about the interest of the Tatas in this particular deal. Let's bring in Siddhartha Khemka. He's the Vice President and Head of Research at Motilal Oswal, who is joining us on the show right now. Siddhartha, thanks very much for taking out the time. I'm going to start off straight up with the stock that's in the center, the eye of attention right now, and that's Jet Airways. What's the call here? What have you been hearing in terms of what could go about with this deal?
Yeah, good morning, Devina. So to start with, on Jet Airways, we don't have official coverage and a rating, hence, so that's the disclaimer. However, reading the comments and the news flows, it looks like, yes, there could be a bailout here, as we know that even Tata Sons are having a board meeting, and that could save the day for Jet Airways. The stock has already reacted in the past few days, moving up sharply. So it's all news driven, and we need to see how and what form the new the merger acquisition takes place. We also heard in between some foreign players also getting interested in Jet Airways, but nonetheless, on the macro side, the headwinds are still continuing for the overall aviation pack. If you see, crude, although corrected from its peak, is still at $65, which is still much higher than what the average was for the previous years. The realizations have also not improved, and rupee continues to be above 70, which is again a big negative for the aviation pack. So that's the view currently on the aviation sector. We have a cautious view right now, given the several macro headwinds that the sector face.
Neeraj, while obviously this particular news is a lifeline for Jet Airways, but the point is to look at the internals and see whether that changes things operationally for the company or no, because this quarter for aviation as a pocket has been so horrible. Together, their losses accumulated to about 2,600 crores, which has been the worst, I think, since 3 years. And, looking by the commentary that's coming around the prices of crude and whether or not crude has topped off and come off now, that doesn't look very promising. So there is a likelihood of crude oil once again bouncing back, according to most experts that we've had conversations with. So whether or not there are actually more headwinds now with the tailwind of this deal.
Yeah, but I don't think people would frankly look at the operational metrics for aviation companies when evaluating this deal.
Not the deal, just in general. When you
Yeah, but I mean, if I'm a minority shareholder of Jet, would this be the best possible outcome that could happen? Because otherwise I was staring at an abyss. And therefore, from that perspective, I think that's what the market got a whiff of yesterday. And maybe that's the reward. I mean, we'll get an analyst in just moments from now to talk about this, so maybe more conversation then. But if indeed this has to go out and happen, then probably the stock price uptick is with reason. Now, at whatever, 320, 350, 400, whatever price the stock settles in, if and when the deal get announced, people will then take stock of what the deal contours are and whether it makes sense or not.
The valuations remain.
Yeah, and the valuations as well. But until then, I believe the excitement is warranted. Let's wait and watch how long it lasts. But as I said, we'll get an analyst to talk about the valuations for this one and the implications thereof as well. But while Siddhartha is with us, just I want to throw in one more question of the other big stock in news this morning, and that is Yes Bank. Siddhartha, now I know that in your dealing room, you guys have been talking about Yes Bank a lot because we had a conversation about this maybe a couple of weeks ago. Two people from the CEO search panel out. It put a little bit of pressure on Yes Bank in trade yesterday. What do you think happens here now?
Yeah, good morning, Neeraj. So the stock has been in limelight for all the other reasons. We have seen two resignations, one from the chairman and now from the search committee chairman OP Bhatt. So these are big names, and definitely the stock is under pressure. So one has to wait and watch how things pan out. My guess is the search committee is on a final list of the new successor to Rana Kapoor, and that is what led to Mr. OP Bhatt looking at a possible conflict of interest, and they are something I think the name could come up sooner than expected, and that could if the name is liked by the market, that could support the stock from here on. But until then, these kind of news flows could create a huge volatility, which we have seen that continues to put pressure on the stock.
Okay. Siddharth, stay on. As we said, an expert to talk about this deal and what it means for Jet Airways as a stock. I think that's the more important thing. Mayur Milak of IndiaNivesh Securities joins us right now on the phone line to take that conversation forward. Mayur, good having you. Thanks so much for joining in. From a perspective of somebody who's a shareholder in Jet Airways or wanting to get into Jet Airways because he believes that, or he or she believes that if indeed a white knight comes in, that's a good thing for the stock. How would you approach this piece of development, assuming that it happens, of course?
Yeah, so assuming that if this happens, I think it is a very strong positive move. Jet Airways has been around for 20-25 years, one of the leading aircrafts of India. And I think if we've already seen crude coming up from 85 to 65. So that sorts my operating metrics. Now, if somebody can really come and support me as on my balance sheet, then I think it's a great buy at these levels.
Interesting. Mayur, the question remains the competitive pressures coming through the pricing scenario, which is in the industry led largely by Indigo, still remains, and that big elephant or big gorilla to fight still remains. It may solve a little bit of the balance sheet issues, but does it take away the overhang on the aviation business by and large? I mean, I was just looking at SpiceJet numbers. Those weren't the best either. So is this a rally in hope of some good news which will peter out at some point of time? Or would you believe the price of Jet Airways should be much higher if indeed this deal were to fructify?
See, I think you have to look at two things here. One, the fact that everybody now knows that this industry right now does not have any pricing power. So that, I think, is pretty much in the price of most of these stocks, right? So nobody really gives them a premium for getting that back. But what we really need to see is that, we've seen a very sharp fall in crude. And that gives a lot of buffer to these guys. So if you're not going to burn any cash in the near term, and you're going to add a significant amount of strength to your balance sheet, it automatically gives a lot of signal to competition also that, we are more competent to fight. And that is why you don't really end up into an ugly fight. If there are two strong guys, I'm sure you don't end up into a huge fight. My point is that if everything goes well, if really Tata's pick up a stake or pick up the entire of Jet Airways, depending on how the deal is structured, the kind of routes that Jet Airways has is one of the best, and it should definitely command a very strong plus from where it is at this point.
Mayur, just one question from a stock perspective, whether you look at it from an immediate term, which is from the eyeglass of the deal happening, or whether you look at it from a longer term, which is the crux of the business and the business model and the aviation sector as a whole, and how Jet Airways is competent enough to survive in this highly competitive industry. How would you approach these two dynamics, and whether or not the stock is attractive or not on the basis of this, the business, the operations, the profitability versus the initial kicker of the deal?
So I think initially, if you really look at the industry, we are one of the best growing industries in the world. We have a very limited penetration so far. And the government's focus on regional connectivity expansion and really getting all the infrastructure in place is pretty much there. So I think for the long-term agenda, this aviation business could be one of the best businesses looking at in terms of demand. Now, as far as competition goes, I think, once you are pretty sure that your demand is going to be in the CAGR of about 15 to 18 for the next 3 years, 5 years, and there are significant entry barriers. We've seen that. We've seen, Tata struggle with both Vistara and AirAsia for a good long time now. And probably that is why even, their desperation to pick up something which is meaningful in Indian Air. I think if you look at all of that, and also the sudden, change that has really happened on the positive side, you would definitely believe that, at 300 odd, Jet Airways definitely makes a strong buy case.
Which is what my next question was going to be to you. Spoke about the losses that Tata's is anyway seeing on a Vistara as well as an AirAsia, and in a market like this, you were seeing low-cost airliners pretty much, competing with the full-service airliners, which is causing that amount of costing pressure, not being able to pass on the cost to customers. Crude oil has come off, it's come off sharply in the last 12 or 15 sessions. No one is here take a call on crude oil prices and the direction of crude oil prices. No one can do that. But nonetheless, if at all we do see crude oil being a significant, overhang within the industry, then probably this could weigh down more negatively.
Yes. So if we are really looking at crude going back to $80, $85, $90, and the pricing power really not coming back, all of these guys will bleed, including Indigo. We've seen that in the quarterly results. We've seen that in the quarter gone by, that most of these guys really bled because while they keep blaming on each other as to not having a pricing power, I'm sure that is a very temporary short-term phenomenon. At the end, if the cost really goes up significantly high, there will be a point where they will all have to start passing it on. You have to be in the business for the long term. You cannot have short-term goals.
Okay, Mayur, we'll leave it at that. Thanks so much for taking the time out and joining in and giving us that quick perspective. I think the verdict from Mayur Milak seems to be clear. From a trading perspective or a trading investment perspective, so to say, Jet at 300, 320 is a good thing if indeed this deal goes through. The long term, well, I think time will tell. Okay, so that's on Jet Airways, quite a bit of analysis. Let's talk about some other names as well. Our research team joins in to talk about all the key newsmakers and stocks that are likely to react. Not too many today, as we said at the start of the show as well, and trade setup. There are not too many stocks that are actually catching the attention. So Samit and Agam join in to talk about all the key newsmakers and the ones that are likely to move. Okay, Agam is busy preparing. Maybe I should start with Samit first. Samit.
So I have the brokerage calls for the day first.
Let's start with those, yeah.
First one is on GAIL India. Now, Jefferies has maintained its buy rating with a target price of around 450 on GAIL India. Now, according to the brokerage, the near-term business conditions have turned unfavorable for GAIL in the past 1 month, and that is because of the expected fall in LPG realizations, rising gas prices in US, and because of lower gas prices in the Asian region. Now, if you see the trading margins of the company is expected to fall from its all-time highs of in the second quarter of financial year 2019 because of the rising gas prices in US and because of the falling gas prices in Asian region. Now, this may all reverse for the company going forward with OPEC cut coming in and also because of the rise in the petrochemical margins of the company, which would come in because of better volumes and because of lower cost and because of the rise in transmission margins, which would be aided because of the hike in pipeline tariffs that is expected to come in by the end of December. The second that I have is on Thermax. Now, Macquarie has maintained its underperform rating on the stock, but has cut down the target price on Thermax to 846 from 866. Now, the brokerage says that the margins continue to lead to a disappointing earnings when it comes to Thermax, and it also believes that taking the margins to double digit would be very difficult for the company given the overall stress in the power sector and because of competition. Now, it also says that the company lacks pricing power in the industry, and that is because it is not a market leader, and that's the reason the margins would also be under pressure going forward for Thermax. Lastly, it is advising investors to switch to Cummins India, which is trading at a discount of around 30% to Thermax and also has a superior return on equity profile.
Okay, thanks a lot for that, Sumit. Agam, what about the stocks in news?
Sure, so we've already spoken about Tata Group and Jet, so I'm going to talk about Tata Sponge because from what we understand is they're going to allot preference shares to the promoter Tata Steel, and that's going to be worth around 1,000 crore rupees. Moving on, Yes Bank once again in focus. This time, O.P. Bhatt, who is on the duty for external expert for the search committee for the successor for CMD Rana Kapoor, well, he's resigned, and once again, this could be a problem. Of course, the reason cited is conflict of interest. SRF Industries extends its capex estimates from 180 crores to around 257 crores. This is, of course, on its agrochemical plant in Gujarat. And Lemon Tree, possibly good news here, considering it's signed an agreement to build a 76-room hotel in Odisha, and they're likely to finish the construction of the hotel by around March 2020. In terms of Baltis, we just want to elaborate on all the names that have bought into the stake that ING Mauritius has sold. So we have Government of Singapore, who's bought 0.5%, Aberdeen PLC, who's bought 0.1%, and Nomura Pension Fund also has bought 0.03%. And finally, we will also have ONGC, IOC, as well as Oil India in focus, considering from what we understand, newspaper reports suggesting $2 billion being raised in order to meet its disinvestment target. So once again, ONGCs should be, oil and gas companies should be in focus as well.
Let's wait and watch. Thanks a lot for that, Agam. So those are some key stocks in news. Actually, just a quick perspective out here, Siddhartha. What have you told your clients to do in the recent past in the OMCs? They are no longer at those 200. I mean, HPC is no longer at 200, but circa 250. Similarly for BPCL, significantly off the lows. What should one do here?
Yeah, so as we discussed even earlier on your show, so crude oil prices were a negative, and the fact that there was a structural change when the government came and asked to share a subsidy of 1 rupee with the oil marketing company. So that was a significant dent on the sentiments as well as on the overall structural change that was taking place in the oil marketing companies. So having said that, we had a neutral rating on the HPCL and the BPCL, while we preferred Indian Oil in the entire pack given the better cash flows as well as the better integrated business model out there. So in the entire space, although we were cautious, the only stock that we were recommending our customers were in that space was Indian Oil.
All right. Siddhartha, just stay on with us. We've got Brijesh, Singh and Bala, both of them joining us to run us through their ideas on the index and whether or not there are any interesting trading plays available there. We'll start off with you, Jay, and what is the overall trend looking like on the index? It's held on pretty steady now for the Nifty this week. No sharp moves. What's the trajectory like?
Yeah, good morning, Devina. See, the major trend looks like the bottom is in for the Indian markets. And over the long term, which I've been projecting for several months now, I think the long-term trend is looking like it has resumed. But in the short term, the market's looking like it needs a little bit of cooling off. It needs some respite in the short term. It's looking very tired in the short term, and so I would expect the index to Nifty to pull back somewhere close to 10,300 ballpark, and post that. I expect the resumption of the long-term uptrend. So I'm neutral on the index. I'm expecting some sort of resistance to kick in somewhere between 10,720 to 10,770 on the index. So it could even be slightly short of that. So don't be too long in the market in the extreme short term. Wait for a pullback to come through. Similar situation for the banking index. I would expect the banking index to face resistance somewhere around 26,200 to 26,400, and I would expect some pullback to come through. The quality of the pullback is going to be pretty important for the long term. I think we are trying to register a higher low for the markets, for the overall market, be it the banking index or the Nifty. So you should be buying that dip. But wait for the dip in the short term. Don't commit yourself in the market at current levels.
Okay, we'll come to your stock ideas in a bit, Jet. We'll just go to Brijesh for his idea on the index. Brijesh.
Good morning, Devina. See, no doubt the Nifty is making a base on the lower sides. If we check it out, a couple of days back, it's been trading in the range of 10,300, 10,350, whereas on the highs at 10,500 it was been acting as a resistor. Now after that, the 10,350 would be acting as a support, and after that it moved up and make a new base at around 10,420 to 10,450. Now again, that bid has been moved up to the level of 10,520 to 540 junction. So I'm assuming this 10,500 should not be getting broken. Whereas on the higher side, we are inching towards the 200-day simple moving average, and before that there are a multiple of resistance, 10,660 to 10,680. But the plus point is what we are touching that level again and again. So that indicates that trend has been stronger, and one day, or say in a couple of days, we might try to break that level. So I'm assuming Nifty to break that level on the higher side, and we might try to touch 10,750 around juncture, where from there we can see a profit booking. So keeping that thing in mind, any dip below 10,580 or say 10,585, one can take a buy call with the stop loss of 10,540. Look for the target of 10,650 to 10,680 juncture.
All right, gentlemen, just stay on. We'll come back and talk about your individual stocks in just moments from now. But on to our special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock or a trend that he spotted. Yash, what's on the radar today?
Good morning, Devina. NIIT Tech is what we are tracking on the charts today. It has been under a bit of a selling pressure, falling for a third consecutive day in this week. And the fear and greed indicator, which is a proprietary Bloomberg indicator, that has turned negative. So let's first try and understand what the fear and greed indicator is. It basically calculates the spread between the two weighted moving averages and oscillates on a zero basis line. How do you interpret it? Well, you go long when the indicator turns green from red, and you sell when the indicator turns red from green, which is in this case for NIIT Tech. If you could get the chart back up, with the move of yesterday, the indicator has turned red, so we are seeing the small red bar over here. A key resistance level for the stock has been the 200-day moving average, which stands somewhere around the 1,084 mark. And interestingly, there is the likelihood of a mini death cross forming on the charts, because the 50-day moving average, it is very close to breaking under the 100-day moving average as well around these levels. So we could see pressure coming in, and as far as NIIT Tech is concerned.
How accurate is this indicator?
So basically, if you went short on this counter, at least over the last 20 days, it would have given you a positive returns of close to 5.5%.
Oh, that's interesting. We'll watch out for this. Thanks a lot for that, Yash. So that's the Bloomberg Edge for the day today. Let's talk about specific stocks. And Jai Bala, two interesting calls. Interesting in the sense that they kind of not calls that people are talking about. A buy on a cement stock and a sell on a tire stock when crude prices have corrected and the fundas seem favorable. Why these two names?
Yeah, see, first let's take MRF, which is a very strong stock, and most of the tire stocks, in my opinion, have made a long-term top, and they're not going to go back to record highs. We might see some pullback along the way, but the structure for MRF is such that the recent pullback from the lows to 67,000 is actually a corrective rally. So the next leg of the down move is actually starting for MRF, in my opinion. So if you want to be a little more conservative, wait for yesterday's low to get broken after the first 10 minutes of trading, and then go short on this counter, place a stop above 67,000 and expect it to drop to 60,000 in the short term. In fact, over the slightly higher time frame, I'm expecting this stock to go much lower. So this is the case for most of the tire stocks, and crude is actually bouncing back and we are likely to see some sizable bounce back come through for crude, somewhere close to at least 72 to 75. So that being the case, that can also bring negative, but my premise is not based on crude price, it's the technical structure of MRF. And the second call is on ACC, which is a long call. Now, most of the cement names have taken some beating all through September and October. This is actually a short covering rally. I'm expecting ACC to climb somewhere close to 1625, 1650. One can place a stop below 1450. You might even see Dalmia Bharat saw a very strong price action yesterday. There is short covering going on in some of the cement counters. So I expect that to continue and expect ACC to perform well.
Brijesh, what about your ideas?
My first call would be Apollo Hospital. Yesterday, we have seen a volume breakout followed by a new 50-week high and close somewhere around that level of 1266. So any dip somewhere around 1250, 1255, one can take a buy call with a stop loss of 1225. Play for the target of 1280 at 1290. But I am looking stock in a week time from touching 1310. And another call will be a Titan. A V-shaped recovery has been seen from a level of 732 odd level, and the price is moving up so that the volume are moving up. So that indicates the strong structure on the chart. So 910, 915 would be the level where one can take a buy call with the stop loss of 895 and play for the target of 945, 948.
Okay, got that. Gentlemen, just stay on. We've got 30 seconds left to go for market pre-open. It's going to be an interesting day. It's the the last day of the week, so we'll be getting a weekly close as well. Hope to have a positive start. Looking at the way the SGX is set up, Shanghai also has actually moved up almost 1/3% from the lows that we took a check on just a few moments back. And Nikkei is down 0.5%, and there's a pickup in Hang Seng too. So closer to 0.5% now on SGX Nifty 10,668. I think the other part to be watching out for is going to be the currency. We closed below that crucial 72 to the dollar mark yesterday. Goes to see if any strength has come about in today's session as well. But that's the Nifty for you, flat right now. For the Sensex, we're up about 0.5%. Individual stocks require more attention right now. And Yes Bank seems to be having another spoiler of a day. So another 10% given up on Yes Bank, 185. And all the excitement around the stock, which had moved swiftly past 200 just a few weeks back. Now, once again, closer to 185. But again, these are just the initial, those active prices that have come in. You'll wait for them to consolidate just in a few moments from now. Tata Motors is the other one that's looking a little bit weak today. HPCL is down 3.5%, Tata Motors down 1.5%, BPCL, NTPC, India Bulls, Housing are some of the losers. Nonetheless, it's more tilted towards the bullish side, at least at pre-open. HCL Technologies is up about 2.5%. Eicher Motors is up 2%. M&M, Tech Mahindra, Bajaj Auto is up 1%. Maruti Suzuki 1% higher. You have the likes of Sun Pharma. Coal India is trading at 265. HDFC, Reliance Industries, not bad at all. 1100 on the counter. But should just pull up the currency to see where it's at right now and the open thereof. So slightly more stronger than yesterday's close, but nonetheless, it's not beaten yesterday's highs.
Yeah, it hasn't as yet. Let's wait and watch if it does. The bond yields at about 7.745. Yeah, thereabouts. So no big changes there. Jet Airways, and pull up that stock and see what that is doing after the big bang move that it had in trade yesterday. Oh, I don't think it'll be a 10% downtick. Let's wait and watch. Yesterday's move was not for nothing. Let's see some key newsmakers. Actually, there aren't too many, but if we can pull up NRB bearings, I thought it was an interesting bulk deal, and let's see if the liquid stock has some reactions, about a couple of percentage points, not too much. So that's one stock to my mind that is in focus and in news in the session today. Aside of NRB bearings, there was also SRF, which I thought was an interesting one. They've announced fresh capex, and typically companies would do that if indeed the volumes and the demand looks like perking up. So watch out for this one. Adani Transmission had a big day in trade yesterday, and let's see if it's reacting further in the session today. For now, about 5% higher, but this may well change. Let's wait and watch. Ujjivan and Siemens are the other two which had big moves in trade yesterday, and let's see if there's a further reaction in those two. Ujjivan on the back of what arguably was a very strong quarter up, and Siemens dealing rooms were telling us that there was some fund-based buying that was seen in cap goods names and particularly Siemens. So let's wait and watch if the move that happened yesterday can actually continue in the session today. 8K miles looked like starting off okay. Care ratings looked like starting off okay. So those are a couple of positive movers. Anything on the downside, just very quickly before we get back to our experts? Jet is stuck, but well, that will probably change in the next 5 minutes. Yes Bank is the principal culprit and continues to remain under pressure. It just becomes such a difficult stock to trade. Yes Bank, to be honest, up one day, up for a series of 3-4 sessions, and then down quite strongly in the series of the next 4 sessions as well, looking like starting off fairly weak in the session today. Watch out for Yes Bank. Siddhartha, Khemka, within the conversations, I mean, the other talking point has been the rollover of the commercial papers that some of the NBFCs have been able to see, and the liquidity situation being not as bad. In light of all of that, what is that NBFC name that you guys have found to be the most favorable to get into? And let's leave an HDFC out. Let's leave a Bajaj Finance out. Those two are probably the most obvious suspects. Aside of that, is there something that your analysis suggests is a good one for people to make investment into?
Yeah, Neeraj, so since you have excluded the bigger and the better names, among the smaller ones, one that catches our eye and could be a good investment avenue is Repco Home Finance. If you see while the numbers for this quarter has obviously been a little bit on the slower side, the growth has been impacted due to some issues that they are having in their home state of Tamil Nadu. We have seen that overall in the past 2 months, the company has been able to hike interest rates twice, amounting to almost 45 basis points on all incremental loans. It further expects to hike rates on existing loans as well. The company has managed the liquidity situation very well. The company has been able to draw down about 4 to 5 billion rupees from bank lines in the past 2 months, and additionally it has also secured a fresh about almost 500 crores line from NHB at a weighted average cost of 7.5%. So if you see the overall business model, Repco is a niche company catering to the informal and the underbanked segment. The company has demonstrated its strength in this home state and has also expanded in other 10 states. While the past 2 years there have been several issues for Repco, both internally as well as in terms of external factors, we believe that the company is now past all these issues. Things are to improve, and it is one of the best positioned in terms of both liquidity as well as in terms of the margins that they earn. Apart from that, if you see the valuations, current valuations are attractive at 1.4 times price to book on FY20 with a ROA of more than around 2.3%. So that's a buy from us with a target price of 550, which gives almost 35% upside from current levels.
Adani Ports is the other one. The stock on a year-on-year basis, though, is down about 51%. However, the recovery from levels sub 300 to a level of about 345, 346, what it's trading at currently, that's not been bad. Jay, Bala, do you track this one?
Which is the other stock, sorry?
Adani Ports.
Adani Ports?
Yeah.
Okay, see, this is a short-term, sorry, just a moment, yeah. This is a short-term positive here, but I don't see too much upsides in Adani Ports. I would, wait for further positives to come through, and I would, expect a retest of the October lows to happen. Post that, the stock will stabilize at current levels, and I would, I would avoid at current levels. I wouldn't be trading it at current levels.
All right. Brijesh Singh, would you go short on an emphasis? The stock has been constantly looking a little weak and on day-by-day basis grinding lower slowly.
See, Devina, if we talk about emphasis, the stock on a daily chart is been trading in a lower highs and lower lows formation. The previous swing low was 1,004, 1,005. That has not been broken. The only positive part is in this chart is that little bit base has been formed at the 900 level, followed by the oscillator giving up high low. So I'm looking 900 should hold on. So rather than going short, the thing is that if it trades somewhere around 920, 925, one can take a buy call with a stop loss of 900 and play for the target of 985 to 995. But on a momentum to continue on the higher side, 1005 has to be broken with the volume, then only we can say short-term, medium-term trend has been reversed from a bearish mode to a bullish mode.
All right, a stronger move for the currency as well now, 71.9 as per the last stick, I think. Yeah, so some amount of strength that's come into the currency as well. Anything else that's looking appealing to you on the charts, Jet?
Yeah, I'd spoken about Apollo hospitals, in September when the markets were falling. I'd said, we have to be in defensives in the pharma space and healthcare space and sugar space. Both have actually done well. Apollo hospitals were a particular pick, and that's actually broken out yesterday. And I had a medium-term call for 1,800 for the stock. I think that trend is continuing here. In the short term, I expect 1,350 for Apollo hospitals. That's looking quite promising in the short term.
Yeah, I just want to pull up Jet Airways once again because as the pre-open rates have settled down, the stock of the last 2 days, let's see what it's up to. 321 and counting, so not too much. Just a very quick perspective out here, Jay Bala. Yesterday, people were of the opinion that the trend could well take Jet northwards of 350 onto 370, 380 odd as well. Would you be a buyer in Jet Airways this morning at 320, 321?
After such a huge move, I'm a bit hesitant, but as a trader, you can still pull because when we spoke about this several times between August and September, a relief rally was quite due for the stock, and it's been long overdue, and it's bouncing back from such suppressed levels. It's like a compressed spring in the short term. So I would expect some sort of resistance to kick in around 360. If that's taken out, I would even I won't be surprised if the stock raises to somewhere close to 400 to 420 mark.
Okay, we'll watch out for all of those. Gentlemen, stay on. Let's tell our viewers all that they need to know to stay ahead in trade today. Less than 5 minutes away from market open. The Tata Group may just turn out to be the knight in shining armor for Jet Airways. Bloomberg reports that the government has sought its help to rescue the debt-laden carrier. The board of Tata Sons is set to meet today.
All right, another resignation at Yes Bank. O.P. Bhatt has resigned from his duty as an external expert for the search committee, citing conflict of interest.
MD Ranganath will step down from his role as the CFO for Infosys today. Deputy CFO Jayesh Sangrachka will take over as the new interim CFO.
Agrochemical unit in Gujarat will be bigger and better. The company has extended its capex estimates to 257 crores from the initial estimate of 180 crores for enhancement and integration of the same.
ING Mauritius sold 0.67% stake in Kotak Mahindra Bank through a block deal. Aberdeen, Nomura and Government of Singapore were the buyers.
And the government plans to sell shares worth $2 billion in ONGC, Oil India and Indian Oil, according to an Economic Times report.
Well, let's see if all of those stocks were to be in focus today. Frankly, not too many stocks which are moving around. The top gainer seems to be 8 Kimals, the top loser, PC Jewelers, Suwin Life and some of the others are looking slightly wobbly. Siddhartha, Khemka, before we thank you, a question that keeps on propping up is Ashok Leyland. Post Vinod Dasari's resignation and a quarter which was a bit lackluster. Is there merit in looking at Ashok Leyland because the valuations have come off? Or would you believe there could be more downsides here, even for a fundamental investor?
Yeah, so Neeraj, it's interesting news development that has happened with Ashok Leyland. If you see on the overall CV side, the structural growth continues to remain. We expect the CV demand to grow at in FY19 and 20, driven by continued momentum in specifically if you see the infra, agri and the industrial pickup. Further, there is the expected mandatory scrapping of trucks, which should benefit the CV demand beyond FY20, and hence we expect the domestic MHCV volumes CAGR about 8 to 10% over the next 2-3 years. If you see specifically to this development, we believe that the key here to watch out for is that the ownership and management The separation of the ownership and management, especially in the case of Ashok Leyland, is very critical to sustain the re-rating of the stock. And if you see specifically, if you leave aside this news, the company continues to do well. The valuations are comfortable. We expect the revenue and PAT CAGR of almost 12% and 16%. And if you see in terms of valuations also, it is trading below its 10-year average EV/EBITDA of 8.2 times. So that's a buy from us with a target price of 147. Nonetheless, these news developments could impact the stock in the interim.
Okay, Siddhartha, we'll leave it at that. Many thanks for joining in today and giving us your perspective. Really appreciate you taking the time out.
You're welcome. Thank you.
That's the view from Siddhartha Khemka of Motilal Oswal. About a minute and a half left for the markets to kickstart trade. Before we get in the top idea, Brijesh, just a quick thought. Yes Bank at 201, 30-second answer. Is it a short at the current levels?
Neeraj, if it trades below it 185, then I'll still go with the buy side with the stop loss of 165 for a short-term play.
Brijesh, are you tracking the Max Group stocks? I mean, some of them have seen a good interest over the recent past.
Devina, not as such. I've been tracking, so would not be able to comment on that.
All right, let's go through your top calls then.
As I said, Apollo Hospital looks good. New 50-week high has been made, so one can go for a buy set with a stop loss of 12.25 for the target of 12.80 at 12.90. Another would be Titan, a short-term play, say a swing base 1 to 2 days for the target of 9.45, 9.50. Your stop loss would be 8.95.
Jai Bala, your top call?
I would go with a short on Tata Chemicals. I'll place a stop above 705 and expect the stock to drop somewhere close to 640.
Okay, 640, a short call on Tata Chemicals by Jai Bala in the session today. Jai, Brijesh, if you can stay on, we'll just take in opening thoughts from you post-market open, but 9 seconds left for the markets to kickstart trade. Expect a start which is marginally in the green, about 0.25% or thereabouts. The question mark only is whether we can build on from there or will it be a lackluster session. But this is how we've started off, 0.33% for the Sensex, Nifty Bank and the Nifty about 0.25% or slightly lower than that. And now the Sensex too cooling off a bit, but around the 0.25% range. The mid caps and the small caps will come up on your screen next. I doubt that we'll be doing too much different. Very, very flat for both the key indices in the session today. So hardly any moves for either the mid caps or the small cap indices. Bring up the heat map and let's see what's moving around. Yes Bank about 3% lower, not surprised there. IOC, BP, HP correcting a bit, ONGC correcting a bit. So the oil sensitives are down. Aside of that, we don't have too much really on the losing side. On the gaining side too, hardly anything. HCL Tech, TCS, well, a couple of these IT names, Wipro marginally in the green. So a bit of a defensive bet. The IT companies are doing okay. Sun Pharma marginally higher. It's fallen quite a bit. And Grasim, which fell about 8% yesterday, marginally higher. Again, Cipla, which has fallen quite a bit, marginally higher. But hardly any strength or buoyancy in the gainers, at least. If anything, the losers have more cuts. Yes Bank and the ONGCs of the world are correcting. We'll talk more about these, but fairly lackluster on the benchmark indices. Let me talk about just a couple of pockets. Jet Airways, can't not talk about that at the start, frankly, more so than the others. It's a stock in focus, correcting about 4% today after the big bang move in trade yesterday. Let's wait and watch if there is more in store, or Jet Airways tops out at around these 320, 325 levels. But difficult to say that really. For now, 3% lower. Top gainers in yesterday's session, Adani Transmission, another couple of percentage points higher. Ujjivan after the 8% uptick, marginally higher. And Siemens had a 5% uptick in trade yesterday, another 0.25% higher. Just want to mark NRB bearings as well. HDFC Mutual Fund has bought a small stake, but has bought nevertheless. It's bringing about a small reaction in NRB bearings, about 4.29% higher in trade. Devina, are you lucky enough to spot anything?
Well, at least on the mid-cap and small-cap index, they're not doing, there's not much happening, but individual stocks are still buzzing around in trade. Absolutely flat on the Nifty mid-cap 100. GM Financials is up about 6% in trade right now. You've got interest in an 8K miles, which has taken the 7-day tally to 47% on the upside for this stock. Quality is the other name. These are names that are a little sketchy, so you may want to be a little more careful while trading these names. Shrey Infra is up 3%. You've got an Edelweiss, which is up 3.5%. I think there is, sorry, that's 2% higher. HCL Technologies, that's up 2%. You've got Avanti Feeds, 1.7% higher. Tata Sponge Iron, 1.5%. Bharti Infratel is up 1.6%. Central Bank of India is up 1.5%. Reddington, Ajanta Pharma, these are some of the smaller names that are kickstarting the day with gains. Spark is up as well, 1%. J&K Bank, Equitas Holdings, gains coming into some of these counters. Losers, Take Solutions is down 4%. Bombay Rayon is down 3%. You've got Eros International down 2.6%. Kaveri Seeds, Subin Life Sciences, VIP Industries, 2.25% apiece, given up for most of these names. Max Financials, that's also down about 2% at 420.
Yep, looking very flattish in the session, and which is why our experts have said they're not taking any index trades. But Jai Bala, coming on the oil and gas names, ONGC, IOC, BP, HP, all of them starting off weak. Is there a near-term trade here?
Oh, definitely, you can go short at current levels and expect about a 5 to 7% drop. They've had they've had a sizable rally over the last few sessions, and this is just a minor correction to that. And as I said earlier, I'm expecting Brent to see a relief rally somewhere close to 72. So that being the case, I think this augurs well for a short in OMC names.
Okay. Brijesh, the IT stocks have started off higher. Is there a trade in any of these, TCS or HCL Tech?
HCL Tech, if it trades somewhere around 990 below, then only one can take a buy call with the stop loss at 975 and look for the target of 1020, 1025. If we talk about Tech Mahindra, right now it's been quoting at 714. So if it trades somewhere around 710 and below, then one can take a buy call with the stop loss 695 or 698 and look for the target of 725, 728.
The gentlemen, will leave it at that. Jai Bala as well as Brijesh Singh, appreciate you both joining in and sharing those opinions with us. Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, is joining us on the show right now. Mihir, thanks very much for taking out the time. Appreciate it. And let's talk about the market happenings over the last few weeks of trade. There's been some bout of excitement that's coming in, not just on the pricing front, but even domestic participation that's been pretty strong, and the maturity of the local investors is showing up pretty strongly. What's your sense on how we are positioned in terms of the market trajectory, and whether or not you actually see this being just a slight amount of correction before which we start a little bit of a peter off once again?
Good morning. Yes, the flow story has been very good, and thankfully the correction, while it was sharp, did not last too long for the retail sentiment to get impacted. So we did not see too much disruption in the mutual fund and insurance company flows, on a monthly basis. So I think that's the good story. The other good news is that oil is come off sharply. That was one of the big risk factors over the last 6 months, and which led to this huge overhang of currency, interest rates, inflation, all that combination. But with now oil definitely settling below 70 or 70 or thereabouts, that's a big relief for the market. I think so those positives continue, and hopefully they will see us to the end of the financial year also. On the negative side, I think the NBFC issue, while it seems to be solved for the time being, I don't think there are major liquidity issues at this point in time for the next couple of months. So for the time being, it seems to be stable as far as the risk is concerned. But definitely credit growth might take an impact, especially to the SME segment and the housing SME, the underbanked segment. So that is something that we need to take cognizance of. So I think there's a mix of good news and bad news, and with the markets having corrected the way they are, probably it's time for some consolidation.
Mihir, I was at the CLSA conference yesterday and, happened to speak to Mahesh Nandukar, and he was of the opinion that though we've corrected significantly on the valuation side, coming off from 2021 levels to about 16 times now, that too is slightly more expensive compared to historical averages. He pinpointed about 8% higher than historical averages, and he'll be comfortable when that corrects. Do you see that playing up on the mindset of investors now?
Well, valuations is something that keeps changing with sentiment and perception. So if the market starts believing that the earnings trajectory will accelerate from here, then probably valuations are not expensive. But if we are not likely to see upgrades in the earnings, then probably, yes, we are a tad bit expensive compared to the long-term averages.
Good morning, Neeraj here. The question mark only is that if you are getting money, would you be comfortable deploying the money right now, or are you waiting for some near-term tactical events to get out of the way, be it the commercial paper rollovers or even the December 11 election verdict?
So the good thing about the markets over the last couple of years is that there's been a huge amount of polarization. We've seen massive sectoral moves even within the market. While the markets may not have done much, we did see massive sector and stock picking opportunities. The biggest example, as we have been discussing over the last year, is technology. Normal boring large cap IT stocks outperformed the market and gave absolute returns of 30 to 40% over the last 12 months, while the markets did not do much. On the other hand, you had a portion of the corporate banking, especially on the private banking side, which was underperforming for quite some time, and which probably is now beginning to get re-rated. So I think within the market there are huge scopes for sector and stock picking, and so I don't think incremental flows will completely stay out of the market. There are definitely value pockets at all points in time, as we can see.
Okay. If I can, I can't shirk away from talking about what is arguably the biggest talking point in the last 2 or 3 sessions. Small space, but actively tracked, if not invested in by almost everybody, and that's aviation. Should a deal happen, shouldn't happen, one never knows, but we do know for certainty that the Tata Sons chairman is going to be making a pitch to the board today. What's your sense, Mihir, as and when, if and when this deal happens or otherwise, does aviation, because of the consistent passenger volume growth month on month, and with crude coming at 65, does it provide a tactical investment opportunity, or that's not something that you look to do generally?
Yes, you're right. That's not something that we look to do. So structurally, for as long as I can remember, we haven't owned any aviation stock because of this huge amount of uncertainty on the supply side, demand side, raw material side, fixed cost side, government regulation side. So there are too many moving parts, and yes, there are extremes in valuations on the upside and downside in the segment, but it's not a sector that we have been able to buy and hold and sleep over it for a long period of time. So it became difficult to track, so we've not owned much of it. The other issue with the sector is there's one big entity which is willing to take losses indefinitely, which is the public sector, and as long as that happens, it makes life difficult for rest of the other players.
The other pocket obviously is oil and gas. Since we were talking about the coming off of crude and what happens to some of these oil and gas players, be it the upstream names like an ONGC or the oil marketing companies. Mihir, would there be a change in strategy here? Do you have a call in this pocket?
Yes, again, we thought it was a strategic play, so we held these stocks for quite some time. But the last 2-3 months, where oil really shot beyond $80 and all, I think the calculations of the government, etc., went for a toss, and we did see some uncertainty on the policy front whether really free pricing would continue or not. But now with oil having settled down below 75 again, probably it's time to look at these stocks. But again, it's a call that kind of we are disappointed that we thought it was a structural long-term call. Marketing margins would remain stable, but as we can see, when there are fiscal considerations, political considerations, those equations can get tossed out of the window. But yes, at this point in time, it's definitely worth a look.
Here, we've come to the close of the Q2 earnings season. How did you chart it out in terms of what beat the street, what met the street, and what really disappointed you?
So I think the overall met expectations has been on the top line. Most of the companies have met top line. The disappointments across the board has been in margins because of input cost pressure, especially the oil-linked segments. We have seen that companies have felt the impact of margins of commodity prices, especially the oil-linked prices, and we have seen some mixed bag on the asset quality. But overall, I think it's been a reasonable experience. The earnings have not disappointed.
Interesting. Mihir, just one question from my end. If you looked at many such cycles, when the currency depreciates the way it has, the obvious port of call, at least in sentiment, if not otherwise, is beneficiaries on the export side. When you look at the when you take stock of the situation right now, would the import, from a valuation perspective, would import substitutes give marketmen as big an opportunity as the exporters, or would you be firmly anchored towards the exporter side, if at all?
So when you say import substitute, what kind of sectors are we talking about?
I mean, there are a bunch of these specialty chemical companies wherein almost all the factors were imported, and now if indeed they are able to supply to the local market at a competitive price because of the rupee depreciation, that kind of fits in the bill. I heard comments about a couple of, or rather the alloy sector as well, which supplies to the metal space, which was being imported earlier and now being supplied locally. Any thoughts here?
Oh yes, so the chemicals and the specialty chemical space is not only an import substitute, it's also getting good export opportunities. We are seeing a good order book of exports for a lot of these specialty chemical companies. So yes, these are segments which benefit from the currency.
You would firmly be anchored to, I mean, would you believe that the export-oriented units, because they are larger sectors, would catch the fancy of investors more, or you're not quite believing that the rupee depreciation and rupee staying sub 70 is a big factor for some of these?
It is a big factor, and I think an equally big factor is the China play. We have been talking about China cutting down on pollution, and that seems to be a structural story. While year by year there are pluses and minuses on some of the provinces in China, and of diluting those norms. But I think the events over the last 3 years have proved to the global MNCs sourcing companies that you do need a base away from China, and China is like pretty much 90% of the world's capacity. So even if 5 or 10% of that capacity moves to India just as an alternate sourcing destination, that can be a huge upside for India. So I think whether it's metals, chemicals, textiles, a lot of the other places, we will see a lot of traction, because I think companies do want to, global companies do want to de-risk their sourcing models.
Mihir, what's the call on IT now? I mean, last quarter around you did see TCS surprise the street positively. This time around, the trophy went to Infosys for doing well. But nonetheless, just rupee, keeping aside rupee being a tailwind, in terms of the business prospects and service offerings from most of the larger IT names, which stands to be a key beneficiary from a long-term perspective, probably say 3 to 5 years?
So our call on IT had been positive. We were overweight most of the last 9 months, and we could capture a lot of the upside in IT. But having said that, I think if we believe that the worst of the oil price hike is done and the currency should stabilize from these levels, I don't think IT will outperform in a situation where the domestic cyclicals start performing. So it still remains a call between domestic cyclicals and IT. And if we do believe that with the fiscal situation and the interest rate inflation situation stabilizing because of oil prices coming down so sharply, then we would prefer the domestic stories compared to IT. So we've actually been reducing our overweight positions, bringing it closer to neutral in this segment.
Do you see the tide turning for real estate as a pocket, Mihir?
No, not in a hurry, especially after this NBFC issue. That situation, I think, probably will get worsened in the next few quarters.
Interesting. Mihir, is there merit in the argument, and I don't know if institutional investors would think that way for real estate. I'm just asking for your opinion, that in a sector which is looking increasingly plagued by a number of things, including RERA, of course, that those 1 or 2 players in a sector which constitutes 10% of our GDP, arguably circa 10%, those 1 or 2 players which are good on all counts will stand to disproportionately benefit. Would you, as a large institutional investor, think of approaching the sector that way, or is it an avoid on all counts?
So we would look for real signs of traction on demand, frankly. So while theoretically, yes, it will be a few high quality players which will be, continuously gaining market share in the next few years. And we've seen that in the last 3 years also. We've seen that the established branded non-leveraged players who have the people's trust that they can execute, they have been gaining market share, and even companies from Bombay have been able to successfully launch projects in Gurgaon just because it's a good brand. So I think your thesis is right. But having said that, a couple of things. One is that for those companies, valuations had become very expensive. And these are not land banking stories in any case. And second thing is residential real estate, which is 80-90% of the game, is still not seeing much traction, especially in cities like Bombay and Delhi. So that's where the bulk of the investments are, and those big markets are not really showing signs of traction.
Okay, Mihir, appreciate you joining in. Thanks so much for taking the time out and speaking to us at Bloomberg Quint today. See you more often.
Thank you. Always a pleasure.
Yeah, that's Mihir Vora of Max talking about his thoughts on the markets in specific pockets. Tell you what, we'll continue our conversation with the markets, but with a bit of a difference. On the other side of the break, we get in Gautam Duggad of Motilal Oswal Securities, will be joining us with an assessment of how Q2 went by. So that's an important conversation. And can't shy away from talking about aviation. It's at about 9:50. Mark Martin of Martin Consulting Johnson to talk about whether buying Jet Airways makes sense for Tata Sons.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, रेज. अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, but पॉलिसी समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times. 62 सालों से हर जनरेशन की पसंद.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Back with Indian Open right here on Bloomberg Quint. The market is in reasonably good fettle, I must say, because we are up about 1/3% for the Nifty, the Sensex about 0.4%, and the Nifty Bank about 0.5%. So it's not a bad start to the trading day. Let's see if this indeed lasts. It wasn't the best end to the earnings season, though. I'm not saying it was weak, but the second quarter earnings were the weakest in over a year, threatening India Inc.'s return to double-digit profit growth thesis. Let's find out from Motilal Oswal's head of research, Gautam Duggad, whether the outlook remains cloudy or does it improve. To his credit, at the end of quarter one, he did say that the earnings picture looked a lot more sketchy than what it was at the start of the year. Gautam, good having you. Thanks so much for joining in. From a Nifty or a Sensex EPS perspective, has the picture gotten sketchier?
Hi Neeraj, good morning. Good morning to your viewers also. See, this quarter's earnings, one has to say a thing that, it didn't turn out as bad as one was fearing 40 days back when the environment was all hazy. You had crude going up, currency very volatile. There was a scare of NBFC liquidity tightening and ILFS default. Investors were quite concerned how this quarter will pan out, and more importantly, how the commentary will be. At the end of the earnings season, one has to say that this quarter's earnings met the expectations. On earnings, we have grown around 12% on Nifty versus the expectation of around 12% only. So it is in line, and EBITDA has been slightly ahead. Top line has been pretty strong, 2-3% ahead of expectation, more than 20% growth. So for the quarter at least, it has gone down reasonably okay without much of an accident. What remains a problem area, however, is the earnings downgrade. That has not come off. In fact, we've cut our earnings estimate for FY19 by 4% on Nifty. And if I were to take a slightly, stretch it to April, in the last 6-7 months, we have seen almost a 10% downgrade on Nifty earnings for FY19. So we are now at around 515 rupees versus 590 at the beginning of the fiscal year. So earnings downgrade have continued, but the quarter has come out quite well. And of course, the earnings downgrade were led by 4-5 commodity companies. So it's not a broad-based earnings downgrade, so to say. But the fact remains that earnings are still in a downgraded scenario rather than stabilizing or dreaming about upgrades. So that is point number one. Secondly, the picture obviously is slightly more hazier given the events of last 40-45 days. But we must also acknowledge that there has been a lot of stability now, whether it is crude, whether it is currency, whether it is bond yields, or even for that matter, the problems which were pertaining to the NBFC sector. Things haven't turned out as bad as people were fearing on NBFC front. They seem to have got money, rollovers have happened, maybe the cost of funds have gone up, and probably some amount of growth may taper for them, but there has not been any big accident as people were scared about a couple of weeks back.
Okay, that's heartening to hear about the roles as well. But since we're talking about earnings, I want to check with you about what stood out for you from an earnings perspective this time around. Was it banks and corporate-facing banks, or was it something else?
Absolutely. Corporate-facing banks were the standout for this quarter, is the highlight of the quarter. We all have been hoping for the peak of the asset quality cycle, and it seems that we've got that. Commentary was pretty strong too. The moderation in fresh slippages, peaking of bad asset cycle, strengthening of provisioning coverage ratio, and the whole environment is right now conducive for the banks. It seems that there will be some market share gains for the banks, and of course more for well-funded high CASA banks. So clearly valuations are also in their favor. So you will see a lot of portfolio shifts happening. In fact, they are already underway. If you see the data of October month of a lot of mutual fund portfolios which has come out. So clearly shift is there from some retail-oriented private banks to corporate-oriented banks, given the change in the environment and also the relative valuations which are in favor of corporate banks today. So that has been the standard. And second standard obviously has been metals, which has once again surprised, and the quantum of surprise has been pretty big. 60% profit growth for our universe was the expectation of 40%. In fact, at the time of preview, if you remember, we discussed that large part of the incremental earnings for this quarter will come from commodity and oil and gas, and that is what has exactly happened. 75% of the incremental earnings growth that we have got this season is from metals and oil and gas.
The other pockets of concern, mainly obviously price-led, was the cement pocket, which disappointed on the realizations. Auto as a pocket, high raw material costs, delayed festive season, that weighed down. Individual stocks had their own stories, like for Tata Motors and JLR. And pharma as a pocket, Cipla disappointed. Sun Pharma wasn't up to the mark. How did you read into all of these?
See, barring cement, rest was factored in. I think auto, we were expecting a flattish kind of performance for our universe, excluding Tata Motors. And same for pharma, we were expecting around 4% profit growth. We got around 7%. So pharma and auto, I won't categorize as disappointment versus expectations. Cement was a big disappointment versus even expectations, which were muted. And what has happened in cement is, while volume growth was pretty strong across the board, the cost pressures have come to the fore, whether it is freight costs, whether it is the whole power and fuel costs. That has spoiled the story for the sector, and I think valuations were also quite high. The sector remains a function of three parameters, which is volume, pricing and cost, and at any given point of time one of that three parameters is not in its favor, and that spoils the earnings show for them. So this quarter was no different. Autos, clearly, I mean, what is more important right now to focus on from a next 6 months or 12 months perspective is how the volume trends shape up. Cost pressures have gone up, whether it is insurance costs, whether it is raw material costs, or even for that matter the interest cost, which has gone up, and there is a fair bit of financing element which is embedded in auto sector growth. So one has to wait and see how that pans out, but a lot of stock prices have corrected in that space, and some of them, I mean, stocks like Maruti, which has always been our favorite, that has seen a significant correction. And I think while I do not have any visibility of next 3 months or 6 months of performance for this company, given the very solid franchise that they have and improving free cash flow dynamics and ROICs there, I'd be very interested in looking at such names.
Well, the currency depreciation only compounded the problem for some of these, pockets. But moving forward into the next few quarters, do you see these pressure points continuing to weigh down on the earnings?
See, one of the most important imponderable today is crude oil prices, and now we've been very lucky. There has been a $20 drop in crude oil prices suddenly in the last 30 days, while everyone was talking about $80, $90, $100. The prices as we speak have settled around 65 to 67. Now it is important to see how long they remain in this range, and given that there are already talks about supply being curtailed, one has to wait and see how the crude oil prices behave and where do they settle, because it has strong implications for currency, very strong implications for inflation and current account dynamics. And coming to the earnings, it obviously has implications for earnings of sectors like consumer, sectors like auto, sectors like cement. So that can have a significant downside risk. But as of now, clearly, as we spoke in the beginning, crude oil prices have settled down, currency is stabilized, and bond yields have also come off. So a lot of negative risk for the earnings, which were staring at our face 30 days back, they seem to have dissipated for the time being.
Gautam, what stocks stood out for you in earnings? I mean, surely you looked at the entire space of those 180, 189 or 190 companies that you guys have, but there must be those 3 or 4 names where the earnings delivery really stood out for you. Which were those?
So I think, let's start with banks. Banks, as I said in the beginning, private corporate banks were the single, surprising factor. They've surprised on the asset quality front, given the muted expectations. So they are one of the biggest positive factors emerging out of this earnings season, whether you look at ICICI, whether you look at Axis, and possibly even SBI for that matter. And that's what I said, that there will be portfolio shifts which will happen going forward, given that people are heavily overweight on, or rather they were heavily overweight on retail-oriented banks, and there was substantial under-allocation towards private corporate banks. So that part of the portfolio shift you will see, continuing. Another stock which stood out for me, and we've always talked about it, was Titan. The whole story of unorganized to organized is playing out to the script for them. It's one of the single largest beneficiaries of the entire GST and formalization of economy. This quarter's numbers were outstanding, whether it is on jewelry front or even on watches front, and the guidance remains very strong. They've seen 30% growth even for the 40-day festival period that we have seen from October to November. So I remain a very strong believer in that story. I think the stock has a very strong potential to deliver outstanding returns from a multi-year perspective, given that the unorganized trade in jewelry is still not able to find its act together. Then there are pockets, where we have seen decent performances. Stocks like Nestle, Hindustan Lever, they went pretty well. And then, of course, IT sector was pretty strong, at least the tier 1, where the expectations were met, 18% growth, which is the highest in many quarters on profit front. Just that stocks had rallied, so there is some cool off that we are seeing there. But it's a good opportunity to get into some of these large cap names. Stocks have corrected 10 to 15%, whether you look at TCS or Infosys. Numbers are solid, commentary is pretty strong too. Just that incrementally your rupee support has gone out now, but fundamentals remain pretty healthy for them, and plus you are seeing capital being returned to the shareholders, so that is always healthy from a valuation perspective. So those are 3 or 4 pockets. Metals have done well, but I remain very cautious on metals from last many quarters, given that we are towards the fag end of the up cycle now, and therefore while profits look solid, possibly the valuations will not have the same reflection, and that is where one need to be a little more cautious.
Just want to pull out Jet Airways. The stock is now up about 8% odd. It was a different scene altogether at the start of trade. The stock was down closer to about 3.5%, now trading higher by 8%. So there is some interest that's coming back in, and those targets of 350 look like they're going to be met anytime soon. Gautam, while obviously the setbacks were pretty known in terms of the earnings from the aviation space and what would cause a drag and a bleed on profitability for some of these names, put together 2,600 crores of losses this quarter. That's one of the highest that we've seen in about 3 odd years. What's the way forward for aviation, and what are the crucial aspects you're going to be watching out for?
Aviation, we cover only Indigo, and Indigo reported losses. Numbers are pretty bad given where the crude oil prices were, but the fortunes of the sectors are closely linked to the crude oil prices. Now, this is where the dichotomy is. While the consumer growth, the passenger growth is very strong, the pricing power is just not there, and there is a huge supply which is coming out. So I think this sector has become a lot more like a trading sector. You take a call on crude oil price and play, rather than worry about next 3 or 5 years, because the macro looks very rosy for them. The passenger growth has been more than 15% for the last 40-45 months. The point is that that growth is not flowing down to the top line because of a host of factors, whether it is related to cost or whether it is related to pricing. So I would avoid that sector, given that I have no clue where the crude prices will settle, and I see no improvement in pricing power in the near term. While it can give trading returns, but from an investment viewpoint, it still remains a very tricky sector to tackle.
Okay. Gautam, earnings versus the market trend for oil marketing companies. What happens here? What's your outlook?
So I think large part of the reaction of OMCs is largely done, because that is flowing from where the crude oil prices have been. Again, on OMCs, just like what I said on aviation, this remains like a trading pack. We are very closer to the election period now for the next 6 months, and the market is quite concerned on the whole regime of deregulation, given the price cut that we have seen, which has come out a month back. I think that the reflection of crude oil prices will be far more dominant on the trading pattern of the stocks than anything to do with fundamentals at this moment. So the short-term direction of OMCs will be a function of where the politics settle down in the next 6 months, depending on the series of elections that we have, and also where do crude oil prices finally settle. So if crude oil prices settle around 65-70 band, then obviously valuations look quite attractive for them, given that they're trading at sub 1.5 times price to book.
Okay. Gautam, before we wrap up, that one space post earnings that you believe is a complete avoid?
So I've always believed that a couple of spaces like telecom, cement, those are spaces where one needs to be far more sure of the structural change in the earnings before one takes an exposure there. So telecom, you see the size of the balance sheet debt, it's quite scary, and the competitive intensity refuses to subside. So that is one space where I'll be extremely cautious. Second space, as I said, is cement and metals, where cycle somehow is not favoring them at the moment, and then there are a host of other concerns on pricing. So that is the second area where I have to be cautious. And third is, of course, the consumer stocks, where the valuations have not left anything on the table. While I'm positive on consumer space from a medium to long-term perspective, but from the next 6 to 9 months, I think this space can have a time correction, because while earnings have been pretty solid, we've got 15% earnings growth, 14% EBITDA growth this season for the consumer space. The valuations are discounting a lot of that, and there is no room for disappointment. We saw what happened with Page last 2 days. There's one quarter blip and stock has given 12-13% correction. So there are bottoms of opportunity in that space. We continue to like Titan, we like Pidilite, we like Britannia and Hindustan Lever. But large part of that space at 50 times FY20 earnings looks like one can wait before one enters that space afresh.
So good. My last question, actually, since you brought it up, post earnings, Page, the ever favorite, has it started looking a bit dicey to make a fresh investment in?
Not at all. In fact, the story remains as solid as ever. This is just one quarter of a blip. The management said that I think it is due to festive season mismatch, and possibly you'll see a bounce back in Q3. What I was referring to was the valuations. At 70 times FY19 and 52 or 53 times FY20, the room for disappointment for somebody looking at a short-term return is just not there.
But Gautam, sorry, Gautam, if I can come in, that's my question really. If 1 quarter of an earnings miss, or could there be more, and therefore would the multiple come off to your mind from those 70-80 times to maybe 50-60 times?
Possible. I cannot deny that possibility is staying in our face, because the bond yields have gone up. And I'm saying from the last 1 year viewpoint, not the last 30 days. The yields have gone up, and therefore the room for equity valuations to further inflate is very limited. What allowed Page to see such a strong re-rating was year after year 30% earnings growth. And what we saw last 2 days was 1 quarter blip where the valuations did not allow that. And that is what we have seen. My conviction on Page from the next 5 to 10 years remains very strong. Just that there is no room for valuation expansion. Business remains as solid as ever. 50% ROC, working capital has also been reduced further. Top line growth remains very strong, and competition is just not there in that premium innerwear branded space. So business is on a different footing, and valuations are on a very different footing right now.
Right. We'll leave it at that. Gautam, thanks very much for joining us. Really appreciate you taking out the time and sharing your thoughts post the earnings season, Q2 of FY19. Appreciate it.
Thank you.
All right. That's Gautam Duggad of Motilal Oswal. But the focus remains on what's happening in Jet. Will Tata Sons be Jet Airways' knight in shining armor, or will it prove to be too big a problem for even the Tata Group to turn around? Well, it's still early days, as the Tata Sons board's approval is just the first of the many that will be required for the deal to go through, if at all. But what does it mean for the aviation industry as a whole and for Jet on its own? Let's ask Mark Martin, the founder and CEO at Martin Consulting. Mark, thanks very much for taking on the time. Your initial take on what this brings on the table, aside from money bags, for Jet Airways.
Morning. Thanks for having me today on Bloomberg. I think from a broader perspective, this does have quite a positive effect on the airline business. Collectively, we will start seeing a more organized, structured airline industry, and that's what Singapore Airlines actually does has done in the past. And so in effect, what Tata gains is about 4 airlines. It's AirAsia, where they have an equity, a strategic investment. They have Vistara. It's Jet Airways, and it's Jet Light, because if you remember, Jet acquired Jet Light in 2006. So, we will bring in a certain amount of organized rationale in the market. And this is also a coming of age for full service airlines that we really haven't seen in a while, at least in India. So this is definitely quite positive. And from an ROI perspective, I don't think Tata is going to look at this as a short-term 10, 12-year investment. They will be in it for the long haul, and we're looking at 20 to 25 years as a total investment, approximate investment window.
While, everything looks good from both the sides, for Tatas, they get an access to the West because of the routes that Jet caters to alongside Etihad. Jet Airways gets that much needed lifeline, that cash infusion, that's been tripling it so far. But how does it all play out in terms of the aviation industry, competitive environment, the possibility of cannibalization, if at all Jet comes in to be one of the third aviation names in the Tata kitty?
Oh yeah, no, absolutely. And I think what we have to be mindful is that we don't think Etihad would be as part of the deal. It's in our view that Tata and SIA will buy out Etihad and give them a golden handshake at a premium price per share, because I think historically we've seen this. SIA and Tata don't want anyone to have a free ride on their investment. On the flip side, we're looking at Jet obviously having an established global network. We're looking at Singapore with its expertise, and we're obviously looking at what one would call as a airline holding company, which is definitely very, very strategic, at least from an India going global perspective. Jet has an established brand. We have to be clear, and that we got to respect that, because it's not just in a domestic environment, it's also in an international airline. footprint, because they do have a tremendous amount of goodwill, especially with sales and market holding. Brussels, Amsterdam, London, Heathrow, New York, Tokyo, Hong Kong, Singapore are all core markets for Jet Airways. So that really adds really well to what SIA's West aspiration has been in the past.
All right. In light of this deal coming about, all these three aviation companies under the Tata kitty put together will have a combined market share of roughly closer to about 24%. What does it leave the others with?
Well, I mean, if you really look at it from in terms of from a pecking order perspective, it will be Air India, Indigo, with Vistara, and we got to be clear, this is a growing Vistara and a fairly sizably mature Jet Airways. So when you merge the two, we're not looking at growth to stop from an airline or fleet perspective. That is going to continue. Vistara will add in the 100 aircraft they talked about. They will go international by bringing in the 777Xs as well as the 787s. Jet already has a 777 fleet, which will obviously be better utilized. And let's not forget, Jet also has an order for 737 MAX. They have an order for 50 aircraft. So I think critical mass in about 24 to 36 months, we're looking at an airline that should have an effective fleet of about 200 plus aircraft, at least in the market today, and with a fairly widespread, broad-based global network, which would be comparable to someone like a Lufthansa or an SIA. So this is more like an SIA in the making.
So net, just before we wind up, you're giving this deal a thumbs up if it happens.
Oh yeah, I think it's if it does happen, it's going to be a great opportunity collectively for the business, and our foreign exchange earnings from the airline business will increase. We'll have a greater forex share, at least on the P&L. But on the flip side, yes, there are risks. I think we all know them: currency and the price of oil. But I think those should be balanced out quite well by the group. So overall, I think I'd like to be positive about this, and I'm sure the markets have been so far. So that's a good indicator.
We'll leave it at that, Mark. Thanks very much for joining us. Appreciate you taking out the time. Mark Martin there giving the deal a thumbs up if at all it culminates and fructifies.
Well, the market's giving a bit of a thumbs up to itself too, about at the highest point of the day as we wind up this leg of Indian Open, 261 points. Bunch of stocks flying around in the information technology space as well. There's some traction selectively, but we'll have to wrap it up because out of time completely on this leg of Indian Open. From Devini and me and the team that put this show together, thanks so much for watching. The FNO show takes forward the action on the other side.